If you're an early-stage founder, there's pretty much no better feeling than securing that first investment. And the SAFE, the simple agreement for future equity, it seems like the perfect way to do it. It's fast, it's simple, and it lets you get right back to building your company. But what if that simple agreement has a hidden price, one you don't even see until it's way too late?
That's the moment we're talking about. That sudden gut punch realization during your next big funding round that the simple piece of paper you signed has some, well, very complex consequences for how much of your own company you actually get to keep.
So, to really understand the trap, we first have to get the appeal. Let's dive into Section 1, the SAFE's simple promise. What makes this thing so darn attractive to founders in the first place?
Well, a SAFE is exactly what it sounds like, a simple agreement for future equity. The key thing to get is that it's not stock in your company today. It's a promise. An investor gives you cash now, and in return, you promise to give them shares sometime down the road. It feels kind of abstract, which is a big part of why its long-term impact is so easy to ignore.
And to see why SAFEs are so popular, you just got to look at the main alternative, the convertible note. Unlike a note, a SAFE doesn't rack up interest, and there's no maturity date when an investor can suddenly demand their money back. For a founder, that takes a ton of pressure off. There's no ticking clock. It feels, well, safe.
But that feeling of safety, it comes with a cost. Which brings us to Section 2, the hidden conversion math. Okay, this is where it all gets real, where that simple promise turns into actual equity, and where the numbers can really catch founders by surprise.
So that promise of future equity, it doesn't just trickle in. Nope, it happens all at once. The trigger is your first priced round. That's just jargon for when you raise a bigger chunk of money from new investors at a set valuation for your company. The second that happens, every single SAFE you've ever signed suddenly wakes up and converts into shares.
Okay, let's walk through a really simple example. Imagine you're a founder and you raise your first bit of cash, $500,000 using a SAFE. Awesome, you're off to the races.
Now, your SAFE agreement has a super important term in it, a valuation cap. Let's say it's set at $5 million. This is basically a protection clause for the investor, and we're about to see exactly how powerful it is.
A year goes by. You've been crushing it. You go out to raise that priced round, and the new investors agree your company is now worth $10 million. This is amazing news, right? Well, this is where the math gets a little tricky. And this is the key. Because of that $5 million cap, your early SAFE investor doesn't convert at the new $10 million valuation. No way. They get to convert at the lower price. Think about it. This basically acts like a lever. They invested at a $5 million valuation, so they get twice the equity they would have if they'd invested at the new $10 million price. It's their reward for betting on you early. But that extra equity has to come from somewhere.
This whole conversion thing creates what we can call an ownership blind spot. It's this dangerous gap between what the paperwork says you own today and what you will own after your next fundraising round.
Here's the kicker, the reason it's a blind spot. Because a SAFE isn't technically equity yet, it doesn't show up on your capitalization table. That's the official spreadsheet of who owns what. So your cap table might show you and your co-founders owning, say, 100% of the company. It creates this illusion of control that just isn't the full picture.
And we're not talking about a small amount here. If you've raised a few SAFEs over time, the scale of this can be absolutely staggering. This quote really captures that moment of shock so many founders feel when the bill finally comes due.
All right, let's actually see what this looks like. Section 4, when your cap table changes. What happens on the day all of that hidden math finally becomes reality?
So before your priced round, your cap table looks great, right? Super clean and simple. Here you've got the founders with 85% and a 15% option pool set aside for future employees. The SAFEs, nowhere to be found. This is the illusion. And then, boom, reality hits. After the price round closes, all those SAFEs convert. All of a sudden, new slices pop up on the chart for your SAFE investors and your new Series A investors. And what do you see? The founder slice has shrunk. A lot. This is the moment of truth. So just to recap how this all goes down, it's a simple three-step process. 1, you sign that seemingly harmless SAFE. 2, some time goes by. 3, you raise a priced round, and bam, the conversion hits all at once, and your ownership is changed forever.
Okay, I know this all sounds pretty scary, but it doesn't have to be a complete disaster. The key isn't to avoid SAFEs, it's to understand them. And that brings us to our final section, how to stay in control. Let's look at what you can actually do about it.
First off, you gotta think like your future investors.
When a new lead investor comes along to lead your priced round, they want one thing above all else: clarity. If you've got a messy stack of different safes with all sorts of confusing terms, that's a huge red flag. It signals risk, and it can slow down or even kill a deal.
And this is huge. They need to know that you, the founder, still have enough skin in the game. Seriously, if you've already promised away too much of your company through safes, a new investor is going to worry that you won't be motivated to stick around for the long, hard journey ahead. Your ownership isn't just about money, it's a signal of your commitment.
So, what can you actually do? You can protect your equity with 3 crucial steps. Number 1, track every single safe. Model out what happens when it converts. What if your next round is at 10 million, 20 million? Know the numbers. 2, normalize your terms. Try to keep the caps and discounts pretty standard on any new safes you sign. And 3, maintain a living cap table. Use a spreadsheet or software that shows your true, fully diluted ownership, not just the illusion.
At the end of the day, a safe isn't really simple at all. Its simplicity is just temporary. You're not actually avoiding complexity, you're just kicking the can down the road. And when that day of conversion finally comes, everything you put off dealing with suddenly becomes very, very real. And that leaves us with one final big question for any founder out there using or even thinking about using safes. Are these agreements really buying you the time you need to build your company? Or are they just postponing a painful math problem that you're going to have to solve eventually? The answer to that will determine how much of your company you actually own in the end.